Welcome to Thursday, Metalheads. I'm Brad, your host of the No Bull Precious Metals Report, and today is June 24th, 2021. So, before I go too far, if you enjoy this report and the content being brought to you, please like this video, share it among your circles, and subscribe for updates. It all goes to feed Big Brother, and by that I mean the algorithm. So, I wanted to start out this report just with a little bit of insight that I've gained over the last couple of weeks of doing this. And there's a delicate balance that I never knew about before I started doing this report. Do I aim to go for a pre-market report? Do I go for a post-market wrap-up? Or do I just brave the crashing waves in the thick of the market day? Obviously, we kind of know where I landed on that one. However, the path is fraught with danger and surprise, and also excitement. Yesterday, as I did the recording, I watched the market change before my eyes. Nothing really new, but to be reporting on as it happened certainly was. And even as I use a snapshot board for my videos, out of the corner of my eye, which I always tend to watch, I could see the prices were moving as I spoke. So all the while through that, I just kept on thinking, I wonder how wrong I'm going to be on this. But I finished, uploaded, and a few of you watched. I kept my eye on the market and watched it go up and then push back down and then push upward once more. And all of this is just to say that no matter how plugged in we get and how much context we try to create, we can definitely be surprised by highs and shocked by lows. Sometimes the market does not make obvious sense, and it's very hard to predict with any certainty. And if you've been in this game for any length of time whatsoever, you probably know that. And no one has all the answers at all. We can look at the data points, we can look at the technicals, we can even look at the fundamentals and start to push everything through and say, you know what, we just don't, sometime there's just going to be this random event that occurs that's going to push things up, and it's going to shock us and surprise us, and market reaction is always going to be different than what we internally predict, because although there is a logic to a rational market, there isn't always sanity. and that's kind of where my point is on this. But as we get into the discussion of retail pricing later, keep all of this in mind, because it's going to come back, and I'm going to circle back into this context, just because it does really relate. So, without any further ado, let's start looking at what's going on in the markets. And right now, we can see that the dashboard is almost the opposite of what it was yesterday. We're seeing the equities and the indices are all green, so they're all positive. And we're seeing the vast majority of the commodities are not necessarily that bright red, but they're all riding the line. Some are slightly greenish, other ones are slightly reddish. So going through all of this, it just shows that, from even a 24-hour period can completely turn things in a 180 degree. So not too much surprise. I mean, right now the metals market compared to yesterday is really kind of riding flat. Copper is the big one that's down at 0.7%. Silver, is a little bit off of where it was. Gold is, down by 0.25%. Platinum's actually up by the whopping 0.03%. And palladium we've got for 0.13%. So looking at all of that kind of sets the tone of where we are. But let's see what's going on today. And if you can see on the calendar, we have our standard initial jobless claims and our continuing jobless claims, as well as durable goods, non-defense capital goods orders, excluding aircraft. Wouldn't want to throw the aircraft in there. Trade-in goods, the advance report, and the revision on the GDP. So our initial jobless claims, we actually rose a pretty decent amount. The previous period was 418,000. Analysts were expecting 380,000, and we finished with 411,000. So although that number is declining, it's really not declining at the speed that analysts are expecting or really the economy desires. So there's still some hesitancy in going back to work. The continuing claims, last week we had 3.53 million that were still on unemployment. This week we've declined those numbers by 3.39 million. So that's definitely a positive step. We're headed in the right direction, albeit it's incredibly slow. Durable goods, the previous period was negative 0.8%. However, this current period is 2.3%. So the orders are increasing, which is always good. Durables definitely underpin a lot of the industry and the economy. So seeing that kind of take a couple of bips up is pretty good. The non-defense capital goods orders did decline though. Went from a 2.7% to a negative 0.1%. So pretty much anything that it was positive, it just stopped. So there is that. And then our trade in goods advance report is the previous period was negative 85.7 billion, and the current period is negative 88.1 billion. So that's a decline of 2.6 billion. So still not necessarily what you want to see in trade. Really positive numbers are generally the better ones. The GDP is remaining flat. They had initially put at 6.4. Analysts are expecting 6.4, and pretty much the revised number came out at 6.4. So good job, guys. Today we've got 3 speakers. They're coming up. We're having the tour of the Fed presidents. 9:30 a.m., which has long since passed. There was the Fed presidents Bostic and Harker speak at OMFIF Fed Week event. At 11 a.m., which we're getting past, the New York Fed president is speaking. And at 1 p.m., the St. Louis Fed president is speaking. The St. Louis Fed president is important, though, because these numbers are aggregated out of the St. Louis Fed. So pretty much the employment numbers and all of the data that tends to get reported by the Fed comes out of St. Louis. So hearing what he has to say could be interesting. Probably check it out if you can. Going down further, let's just check on that 10-year Treasury. And not surprisingly, we kind of flattened out. The last 3 periods, since the 21st, we had that one uptick that kind of leveled. And then the 22nd remained the same at 1.48. Yesterday it was 1.48, and it's currently trading at 1.48 with a 1-point spread between high and low. Or, sorry, a 1/100th of a point spread between high and low. So the interest rates are pretty much holding at this point, which is good. And that also signifies a significant strength within equities. Because there does tend to be an inverse correlation between those two. As interest rates gain, equities tend to decline, so on and so forth. It doesn't always hold true 100%, but that's kind of the truism of it all. So moving forward, let's just take a look at the Fed reports. You can see the unemployment that I do track as a graphical representation. And we can see that the lines are moving down. I'll start with this. So if that was a positive number, this shows a definite decline in where we're going. The continued claims are always a week back. So as we look at that, we can definitely see how that's moving. The other thing that we'll see here is the M1, M2 26-week look back. This is tracking how much actual money supply exists within the economy. And we can see that from the previous period, which was May 24th to May 31st, We are at a slight increase in the amount of money supply overall. M1 is a lower category, but M2 is the combined. So again, there's lots of money out there. Go get some for yourself. So moving on to the markets, let's just look at what the crazy insanity of all of this has been, and see where everything's gone. And there are some interesting moves that I'll highlight. But as we go into the 5-day, we can see on this the 21st, 22nd, 23rd, 24th, all the way through. From so we're currently incorporating the entire trading week on the 5-day VWAP, and currently silver is considerably higher. So as you can see, we've got this movement up here. We're definitely tracking upwards. Yesterday we had wound up hitting that high point of 26.31 in the morning, pretty much about the time when I was doing this and watching out of the corner of my eye, as we had this big spike that went up and kind of moved, and we could see even that spike was big enough it actually adjusted the VWAP on the 5-day. And then of course we had this crash down that came down as low as 25.87 by 3:40 in the afternoon. So from there, we just kind of rode all the way up, and it was a slow, slow incline, but we kept on going. So if we look at what that did on the previous day VWAP, we can kind of see, we're hitting that, and it was an interesting line of resistance that kind of showed up right there. That the current decline at was that at 8:45 this morning, at 26.105, really kind of met that resistance line, bounced off. So kind of interesting how that's forming. And then we look at the intraday, and the intraday is just, it's on the incline. It's definitely moving upwards. So it'll be interesting to see how this kind of shapes up throughout the day, and where this is all going. I'd be interested to see what you guys think. If the trend holds, let's just throw ourselves a good line here. We'll start there and keep going up, and I will go from here. Again, these are very non-exact, but we do kind of have that channel that's existing. I mean, if we're keeping on going up, we can expect probably, my guess is somewhere in the neighborhood of 26.30-ish, somewhere in there. But we'll see. It's hard to say. So looking at gold, bring this up again. We kind of have the same arrangement. We had that same spike that occurred, brought us, man, within a breath of that 1800 mark again. I always feel much more comfortable when gold's over 1800. It's just, there's no specific reason for it. It's just really kind of a comfort level for me. But we went all the way from these highs, which were, I mean, definitely were, I'm going to say +2, +3, +4, probably +4.5 standard devs away from the VWAP, and we crashed all the way down to the -2 standard deviation. So I mean, we caught it right there. We got up, we went through, we hit it again, bounced, hit it a third time, and kept on just reflecting off of that point. And then we dipped right below, and then right after that below, we started the ascendancy that we saw until whatever's going on now. So we were at, what was it, close? 1783. And we dipped down into 1776, and just as I kind of shift my eye sideways, it's 1781 as I look at it now. Because again, I do freeze these boards just so that there isn't continuous updates or anything crazy going on with it. So that's kind of interesting. We'll have to see where that all goes. But then, looking at where the previous day VWAP shows up, I mean, we're right around that +1 mark on the 5 day. So that's 1783. And then, of course, the intraday is at 1782. Just always interesting to me that, we have a very revolutionary kind of a vibe going on. 1776 is the base price, 1783 is previous day VWAP. If you're a Revolutionary War nerd, such as myself, you'll find some humor in that, but otherwise we'll just move on. So that's kind of the markets. Let's take a quick view at how their performance is. So over the same periods, we can see what silver's doing. Let's overlay gold. And we can kind of see where that, we're talking about that convergence that we were seeing yesterday. As we start going through, we had that slight divergence here. But again, I mean, even at its wider points, I mean, we're still talking about, 0.6% in terms of overall variation. So right now they seem to be pretty well aligned and in tune. And just for kicks, let's throw copper on that. Yeah, and copper's just doing its own thing right now. So not much, insider value. But what I always find interesting is as, silver starts to align more with the performance of copper versus the performance of gold. And it kind of shows that bifurcation, that bipolar nature of silver versus copper versus gold. Silver kind of has foot into two distinct areas and two distinct markets. So as you start looking at it as an industrial metal, it might align a little bit closer to copper, especially based off of manufacturing reports and things like that could drive that price. As we start looking at financial aspects of things, such as banking rules or other types of regulations that come in, you start to see that copper or silver and gold start to move a little bit closer together. So whatever way it actually chooses is going to definitely be interesting in the future. But for right now, we can just look and just absorb the pretty colors. Our gold silver ratio is currently sitting at 68.17 market on market, and on generic to generic we're at 59.15. So that gives you your GSR for the day. So volume, not really much to talk about. Volume is still kind of in that, meh range. There's not a lot that's going on. We did have that spike yesterday. Gold was at 46.69 thousand. Still kind of off of where I'd expect it to be or where I'd want to see it. Silver was definitely kind of riding lower. Today, that there isn't a lot of volume. And what that means for anyone that's watching is that when you don't have a lot of participation within the market based off of volume, it's significantly easier to move the price based off of very little actual participation. If you start, a carefully crafted strategy could be to jump the price or drop the price. And oftentimes this is what we see that occurs in the middle of the night when the Asian markets and the European markets are involved, is that they are traditionally lower participation periods. You just don't have the volume. So as you start getting any type of activity going on, it's going to drive the price in one way or the other. But then, of course, by the time the morning rolls around, you're going to see the price snap back. So this is kind of one of those days. I mean, this is almost equivalent to what you'd see within, an overseas trading period versus the U.S. trading period. And, I mean, that's it. It all depends on who wants it more right now, and whether we're going to start getting reinforcements coming in to secure positions. It's hard to say. So let's diverge now. Let's shift over into the retail markets. And not surprisingly, as we look at our benchmarks, we're still seeing the overall decline, which is absolutely expected given the price decline that we saw last week. We are seeing a little bit more recovery, not significant though. So, we've got our 1 ounce generics, 31.47 average. The Philharmonics 32.77. The Maple Leafs 35.41. And the Silver Eagles at 41.47 on average. And, our 10 ounce silver bars are averaging around 31.07 per ounce. So definitely there's a lot of movement here. And one of the things that we can see is as we start looking at these charts, the average price charts, we're seeing more consolidations. Generic is kind of riding right in the middle. There's a good spread. Average and median are kind of converging together. They're only a couple cents off. And they're pretty much right in between the high and the low. So that's really what I'd expect out of a good, bell curve type of a distribution of pricing. So you should be able to find some decent prices, things like that. But let's take a look at, say, the Philharmonic. So the Philharmonic I talked about yesterday and gave some examples of. And this is always interesting because in terms of a sovereign coin, we're seeing kind of this average that's sitting there at 32.84, but the median is significantly lower at 32.19 and actually very, very close to the low price of 31.96. So you're not too far off. And in fact, the vast majority of coins are closer to the lower end than they are the higher end. So if you're looking to get into sovereign coins, I really kind of dig the Philharmonics. They kind of make me happy. And if we look at say the Maple Leaf, we can kind of see a very similar type of a pattern. There's high prices of 42.05, but yet even average is 35.58, median's 33.67, and the low is 32.30. So there is a pretty good distribution there, and it's definitely skewed towards the low end, which is very great. So going through, we can look at that where premiums lie, and not a significant amount of change. Even according to percentage, the actual raw premium price, that margin, that $5.31.5, that's remained relatively level despite the price. And over the last 30 days, we've had quite the rolling price range. So as we look at that, we know that the percentage changes, but the actual margin hasn't that much, which should be indicative to anyone that's looking at this, saying, okay, there is a floor to this stuff, and especially for the generic silvers, you're looking at about $5. So that's something to really keep in mind as you start to shop, is that that's kind of where we're looking at for everything all in. If we look at like the Maple Leaf, we did see a slight adjustment. It went from, June 18th, it was $8.31, jumped up to $9.66. So definitely that did have an effect. Silver Eagles have remained roughly consistent. Although, same period, we went from, $14, 15 cents up to $15.74. So that there was a price difference that occurred. And the Philharmonic, had that same type of a jump, but it was definitely not as drastic as we've seen with the other sovereign mints. Moving into the market to retail, this is a very telling graph to me, because it shows that there's some confusion within the markets. There's some disorder that's occurring, and by that, it's hard to say based off of the tracking of this. Well, there are two hypotheses that I have. The first one is that there's general confusion in pricing that's occurring, that's kind of dragging various items around, and no one's really sure where to settle on it. The second hypothesis that I have, which is kind of correlated along with that previous graph that I just showed on the spot retail comparison, is that there is this that the distributors want to move prices into a different way, and they're trying to diverge the prices a bit. And this is kind of indicative of how those prices are moving on, say a daily basis, in that some are moving a little bit slower than others, some are moving a little bit faster than others. And as you know, that if you take small changes and you add them up over time, they eventually turn out to be pretty big divergences. And so is this a question of confusion within the markets trying to adjust to a rapidly moving spot price? Or is this a concerted effort by retailers and distributors to readjust their price levels? It's a good question for the comments. However, the one thing I did want to bring up, one of the videos of another channel that I watch is Silver Joker. And he just posted a video yesterday that was an interview with his local coin shop owner that was talking about premiums and where they kind of factor into the entire retail chain. I'm going to post a link in the description. I do recommend that everyone check it out. It was pretty informative. I mean, especially from the ground level retailer view of things. So definitely give your time and give some love to the Joker. He's a decent guy. So let's move on to gold. And gold, as I kind of brought up yesterday, one of the bellwethers that I've been looking at is not necessarily the 1 ounce pieces, but it's really these 10th ounce pieces. And right now, what we're seeing is the 10th ounce American Gold Eagle is up to a 3-week high. So right here, we're at 25.67 for, what would be the equivalent ounce. So if we take 10 of those and multiply them, what we're seeing is that the total price is more than it has been in the last 3 weeks. But the other prices are down. However, we are starting to see a little bit of an upward shift on those. So even though gold is kind of repressed, there does seem to be this movement within the average prices as they're coming across on each of these bellwether or these benchmark units. So it'll be interesting. I want to see where they kind of shape up tomorrow as we end this kind of chaotic week or chaotic 10 days. And this also plays out. We can see, what I was talking about. On the average gold. And although everything is, let's just pull this from here. And we can see that there is a slight incline from where things were in at the beginning of the week or the start of the week. Is it significant? No, not really. But then again, I mean, this looks at an average in a different way than the previous average does. So within that, we can kind of see the prices are adjusting. They're shifting upwards a bit. But we can see this even more as we start looking at this 24-hour view. And we can see that, pretty much everything starts out consistent. It keeps on tracking. That gold buffalo always separates. It wants to run by itself. In this particular instance, it's actually, declining in price slower. So it's trying to maintain its value during this period. And then, we get up to here, and all of a sudden the panda, for whatever reason, jumps up quite a bit, while the gold buffalo keeps on rising. And there's a good distance between either of these and the spot price itself. So these are definitely rising in advance of spot. And we're seeing this considerably as we go in. So by the time all is said and done, there's a 0.72% difference between, say, 12:30 a.m. for the Chinese gold panda. It was at 0.09. It's now up to 0.72. So 60.63% increase, whereas spot wound up with a 0.06% increase overall. So definitely something that, and both of these started out with zero. I just wanted to throw that in there to provide a little bit of context to my rambling. So you can see that all of these things are moving in different ways, and it'll be interesting to kind of see where they're shaping up and where these prices are going to wind up going. So the thing that I want to bring up finally, as we kind of wrap up this show, is I spent yesterday looking at the silver scatters, but I wanted to bring up a couple of the gold scatters because these tend to be a lot more direct. And one of the things that we can see on this is just the generic gold. We can see a pretty direct linear correlation. We know that from this relationship and the scatters from the last 90 days, 14 weeks worth, is that if this price continues along at this rate, that we can pretty much extrapolate and say, if price is up here, if spot gets to 1950, say, we're going to see that the actual retail price is going to be probably, was this one? Probably around 2050-ish, so somewhere in that neighborhood. So it's a pretty obvious relationship. This is a great line. When you're looking at stuff like this and trying to determine causality or predictability or anything like that, I could put this in front of a kindergartner and let them kind of figure out, hey, where will the price be, do you think? And it doesn't take too long, and maybe not a kindergartner, but we'll say a fifth grader. Let's go with that. So even if we look at like the American Gold Eagle, the prices are a little bit wider. We don't have the stratification that we saw with silver. Reference back to yesterday's video on this for further explanation. But we do see that the same line exists. That there's a slight hump or a slight bow over across it. But one of the things that I love looking at is the American Eagle 10th ounce. This is just one crazy thing. And this really, if I were to define something based off of this, or if I were to title this chart differently, I'd say this is the reason why you should save your money and buy something without the crazy premiums. Because there's so much price variation that occurs between between what we're dealing with here and everything else. This is just the 10th ounce is just, how do you make sure that you have a good deal? What's the correlation? We see that there is a general group here, that kind of falls in, but then we've got these, which are great deals, which, spot was at 1910. This price was at 24.98. Yeah, there's a decent, $587 gap on it. And that was early June. However, we get up here and we'll say, spots at 1784. This price is 26.47 per ounce. With the total differentiation between $862.80, and that's today. So we start seeing this stuff, and it's like, that's why I've never been a fan of fractional gold. I understand the allure of it, getting into gold for quote unquote cheap, but you have to realize how much more money you're spending on it than what you would in something else. And also just the variation in pricing and everything goes on with it. So that's why I had to say. That's going to do it for today's report. Tune in for the Friday edition when we can recap the week's events and look into what may head our way into the coming week. So until next time, happy stacking.